You're welcome to the Economy and Politics Show. I'm Ottoabasi Abasiekong. This edition will discuss rising inflation in Nigeria and implications for the retail investors. Joining me virtually for this conversation is Professor Uche Uwaleke, the Director, Institute of Capital Market Studies, Nasarawa State University, KEFI. Nice to have you on the program, Prof, and congratulations, the first of its kind institute of capital market studies, not only in Nigeria, but in Africa.
Thanks so much for the compliments.
Yes, thank you. So let's begin with the headline inflation rates for February 2024. According to the National Bureau of Statistics, it rose to 31.70%, which is unprecedented in our country. It's continuing to rise and a huge concern. For you, what are the implications for households grappling already with the challenging economic situation and diminishing purchasing power? And also, are there when you look at the current economic plans in the country from the fiscal side, are you seeing it able to mitigate the effects at this point?
We all know, if you like, the negative impact of inflation on not only households, firms, and the government. So on economic agents in general, inflation is a nightmare, especially when you have a situation in which it is more or less in a running form. So runaway inflation is what we have. Inflation rate that is in excess of 30% is quite worrisome. So of course, for households, the purchasing power of the naira is being diminished, and you can also see that these days a lot of people no longer see naira as a useful store of value because of the negative impact of inflation. So it's affecting everyone, except perhaps for those who are the debtors, those who owe. But virtually everybody is feeling the impact of inflation. I'm sure you're also feeling the impact from earners. For those of us who are on fixed income, it's not something to cheer about at all.
So my follow-up question, of course, is when you look at the fiscal policy framework at the point, is it helping to mitigate the effects?
I like the question. It's a very good one because when we talk about inflation, each time the problem is identified, the natural place to think of in terms of solution is a central bank monetary policy. Of course, central bank has a primary responsibility of maintaining price stability, of ensuring that inflation, we achieve low and stable inflation rates. But in our own circumstance, it is not something the central bank can do alone, given the drivers of inflation in Nigeria. When I say drivers, I mean even the major drivers of inflation. Yes, there is a monetary component, the fact that money supply must have contributed, but there are also the supply side factors, the structural issues that are outside the scope of the central bank, which the fiscal authorities are supposed to be dealing with. Talking about insecurity, for example, that is preventing farmers from going to farms. That's not, for the monetary authority to handle. Talking about rising energy costs, electricity, these are factors that the government should be dealing with. And the question, I think some steps have been taken in that direction. I'm aware the government is working on the security angle, even though it appears to, be getting, it seems it's getting out of hand. But I'm sure the government is aware of it and is, trying to do something to handle the issue of insecurity. Then, of course, there is the issue of rising energy costs, particularly the issue of fuel. Today, if you bring down the cost of fuel today, I can tell you inflation rate will moderate. We have seen it in Kenya. We just saw it in Kenya now. In Kenya, petrol price is coming down. And what do we find? Inflation rate is also moderating. We also find that even the exchange rate in Kenya is strengthening, on account of some fiscal measures that the government of Kenya, has taken. So if we can, as I said earlier on, bring down the cost of energy, particularly fuel and electricity, I'm pretty sure the inflation will come down. And what's the government doing in that direction? Well, we hear the Port Harcourt refinery will soon be up and running. And let's hope that materializes. So if our local refineries can function, in addition to what the Dangote refinery, and we end the importation of petroleum products, that will go a long way in saving forex. So, reducing the pump price of fuel, which will, translate into also lower cost of production. There is also the issue of power. I'm aware the government is also doing something, in that direction.
Thank you very much, Prof, for what you've said. And it's very clear that the fiscal side has a very critical role to play, especially in addressing the cost of energy and, of course, power. So if energy in terms of the fuel pricing and, like you said, the cost of electricity goes down, it has an effect on inflation because at over 30%, it is unprecedented, and we want that to begin to go down. Well, let's look at the retail investor in the equities market, another part of the capital market ecosystem. What does this high inflation environment mean for them? And what advice do you have at this critical time? Because we're all watching, all those are invested in the capital market, retail investors particularly. How should they approach this period?
Well, of course, inflation is one indicator that every investor should be watching out for. Every investor is after positive rate of return. And for the rate of return to be positive, that return has to be ahead of inflation rate. And the way it is now, it does appear, okay, particularly from the point of view of equities, investment in equities. You find that with year-to-date return at about 40%, and inflation rate running at 31.7%, the real rate of return from the equities market in Nigeria is positive. And also that's also what is contributing to the positive sentiment we still find in that equities space, because the return is positive. Yes, recently we've seen some corporate results, positive corporate results coming from the likes of even Dangote Cement. Dangote Cement is talking about dividend of 30 naira per share. Now you find that what has also been happening now, the major drivers of the, if you like, the bullish sentiment we find in the markets also is coming from industrial goods, industrial stocks, where you have the likes of Dangote and you have the likes of BUA. Wow. If you look at the data from the NGX, it says that year-to-date return is about 40%. It's absolutely important for retail investors to diversify their investments at this time. Okay, any retail investor going to the market now should have that at the back of his or her mind. It's not just going to say buy Dangote Cement or going to buy BUA, Dangote, buying equities from the same sector, or buying Zenith, GT, Access Bank in the same sector. It's important, that diversification, should be observed when investing in the equities market. And for me, the best way to do that for a retail investor is to approach the market from, a point of knowledge, a position of knowledge. Okay, and that is also why I will advise every retail investor to always seek advice from professionals before investing. But by and large, for the real retail investors, the people I call real retail investors are actually the people playing with low funds. The best advice would be for them to go through mutual funds. So go through the institutional route, okay, and not just attempting to invest directly in the market through your broker. You don't call your broker and say, get me this stock or get me that stock, except you're a high net worth individual. Okay. Outside of high net worth individuals, other individuals are usually advised go through the mutual funds, where you have professional managers that will help you, undertake this diversification. So if you look at the market today, if you go by the January report talking about the domestic and foreign investor participation in the market. It says domestic investors are actually the ones dominating the transactions in our market, not foreign. In January, they dominated by as much as 84%. Now, if you further analyze domestic investors, you realize that it is institutional investors that are also dominating. So retail investor participation is still not where it should be, given our population in the country. Okay, we hear is in terms of retail investments that CSCS will tell you that there are just about 6 million accounts. And 6 million accounts, for a country of our size is still small. So for us to have increased participation of retail investors, this education, part of what you're doing, which is what I commend, is very important. They need to understand how to play in that market. Okay. Inflation is one major consideration that a retail investor must have. And now that equities markets are performing inflation, especially when you compare to other asset classes, fixed income, for example, other asset classes are not giving the kind of returns we have in equities. But again, the question is how sustainable is that going to be, especially against the backdrop of the recent change in stance by the monetary authority. Going forward, it's expected that interest rates are going to go up. It's expected that fixed income in the yields are going to go up, and so one should also expect some rebalancing, to take place from equities to fixed income. So in the meantime, how do you play in the equity space? It is through diversification, and as I said earlier on, it is also through ensuring that any investments that one is making should be done, from the position of knowledge and using professional advisors licensed by the Securities and Exchange Commission. So that's very critical. But it's also important that retail investors, continue to monitor the inflation rates, continue to monitor other risks, in the economy that may impact the equities, equities market. One of which, I've just mentioned, is this issue of high interest rates environment that is likely to unfold. So a good, savvy retail investor should be conscious of that.
Okay, thank you very much, Prof. It's very clear. Diversify your portfolios and also get professional advice. And there's also opportunities to the mutual funds, but it's very important to monitor inflation and high interest rates. That brings me to the next MPC meeting holding this month. I know that you were featured in one of our major television platforms, and you were really saying that the 400 basis points increase last month in the monetary policy rate was a source of concern concerning the impact on the households and businesses. What do you expect to happen in the next MPC meeting? Do you see a review? What was going to happen? Another further increase in NPR?
Okay, yes, Ambassador. Well, let me approach it from two perspectives. The first is to what do I expect to happen, and then the second angle is what do I think should happen. Okay, what do I expect should happen should be, should be from reading the body language of the CBN governor, and trying to also decipher a few things from what he has been saying so far. Okay, so what I expect to happen, what is likely to happen, is that the MPC, may also raise rates further, especially given the pressure that is coming from the IMF. If you saw the recent Article 4 consultation reports with Nigeria, IMF is still saying that the central bank is not tightening enough. Central bank needs to tighten further in order to narrow the negative real interest rate. As you know, part of the decision for March will be influenced by this recent February inflation rate results that National Bureau of Statistics released. Okay, inflation rate still went up. Okay, despite the tightening that was done by the MPC in February. Although people will argue, and correctly so, that there is usually a lag, policy lag. Monetary policy, of course, has policy lag. But the MPC will be influenced by the fact that inflation rate is still on the rise. And so they are also likely to further hike the monetary policy rate. So I see another hike coming in March, maybe by as much as 200 basis points this time, to send a signal that central bank is serious, that they want to sustain the tempo. Okay, but that is what is likely to happen. But what do I, in my view, if I were a member of the MPC, I wouldn't vote for another rate hike. Okay, I would rather maintain it the way it is and see how far it permeates, through the economy. The fact remains that inflation rates, the moderation of inflation cannot be brought about, just by using a single tool, the monetary policy rate. And remember what they did in February. They didn't just increase monetary policy rate; they also increased the cash reserve requirements to 45%. So, and I think that was, too drastic a measure. But having taken that measure, I want to advise that they hold rates this time, at least to show concern about its impact on growth. Monetary policy has impact on growth. Monetary policy has impact on access to credit. Okay, and it's important that the central bank also recognizes that. Now, let me also tell you what is likely to happen if rates are further increased and banks are repricing their interest rates, for example, their loan lending rates, and people are having difficulty accessing credit. You also find that the cost of production will go up. And if cost of production goes up, this will also be passed to the final consumer. Then you come back to square one. The inflation you're trying to bring down will not come down because of high cost of production. So for inflation, there's always a cost push side and there's a demand pull side. What the central bank is doing is to address the demand pull, too much money in circulation. But in doing that, there should be a balance. In doing that, you don't have to kill the ability of economic agents to produce because you want to force down inflation. So I think central banks should always have that at the back of their minds, MPC, when they are making decisions. We have the asset channel in monetary policy, which speaks to stock prices or the stock market. So if rates are raised so high, it's also going to hurt what happens in the stock market. And I'm happy that the SEC-DG is a member of the Monetary Policy Committee.
Yes.
We have this time around, the capital markets is fairly represented there. I want to believe that he will be also canvassing some of these arguments at the meeting of the MPC. Of course, I want to commend the central bank for what they're doing in terms of trying to stabilize the exchange rates, the reforms in the forex markets. Okay, so those reforms are very good, particularly what they're now doing to sanitize the BDCs. So those are the things that actually helping to stabilize the exchange rates, to bring down exchange rate, and not necessarily the issue of rise in MPR. Okay, so if they can also find a way to get the state governors or state governments to sterilize excess FAC, some of the excess FAC they're getting, that's also helping to put pressure on the foreign exchange markets. That's the way to go, rather than just focusing on one tool, which is the monetary policy rate. Because even if you raise the rate today, MPR to 30% or 35%, it still doesn't. It won't still solve the problem. It will rather create, worsen the problem. So to say, yes.
Yeah, I agree with you. I mean, there needs to be a balancing in monetary policy approach, especially the MPR, so that it doesn't really aggravate pressure on households and retail investors. Just one last question. We've heard of the plans by the Central Bank of Nigeria to drive the recapitalization process for banks in the country. From you, how did you receive this, and what are the implications for the capital market? Late last year, the CBN governor said recapitalization of banks will happen, and as we await it, what are the implications for the capital market and the issues around capital for banks? Yeah.
Beautiful. I like this question. It's going to be very positive for the stock market in particular, especially if we go by the experience of 2005. In 2005, the capital market was able to assist banks to recapitalize by as much as 400 billion naira. As at that time, the banks were able to raise between 350 billion and 400 billion naira from the stock market to help with that recapitalization. You remember, from 89 banks, it came down to 24 banks when it was put at 25 billion. So the stock market played a major role. And we also expect that this time around, the market will also play a major role. There has been this question as to whether the market has the depth, to be able to carry such, a plan by the central bank. But I think the market should be able to do that. You can see even our domestic market pension funds today, the size is inching close to 20 trillion. Even though, of course, we know that it's only a portion of that can be used to get into equities. There is also mutual funds, and apart from the institutional investors, we also have high net worth individuals and other retail investors that will be attracted to the market with the recapitalization. Time you find a number of banks, already we have Fidelity Bank, First Bank, they're making plans to raise capital. By the time these banks come to raise capital, you can be sure this money will come from they will just come from nowhere. Okay, the money you think is not in the system, you find it coming through the market, to help recapitalization. Of course, market cap will increase, the size of the market to the GDP will increase, and all of this will be positive, for the economy. And that's also why I would advise the central bank to, of course, make it clear the way they made it clear in 2005 that for the purpose of recapitalization, they want to encourage banks to go to the market to raise funds, and not necessarily through revaluation of assets. In 2005, it was not allowed. And even mergers and acquisition, of course, those ones have their own drawbacks, issues around culture, different banking culture coming together and so on. So the best bet for banks will actually be to raise fresh capital, from the market. And I think our stock market, will be in a position to do that, just as it delivered in 2005. So the potentials are there. And I'm also happy. I understand the central bank is also engaging stakeholders on what should even be this minimum capital, trying to determine the size of the minimum capital. It shouldn't just, central bank, of course, wouldn't be expected to just come up with a number without engaging the stakeholders. So in this connection, I would advise central bank to engage the Bank Directors Association of Nigeria, engage the Bankers Committee, engage the Nigerian Exchange, engage Securities and Exchange Commission, engage all relevant stakeholders in order to come up with, the right, if you like, the optimal capital, for banks in terms of minimum capital base.
Thank you very much, Professor Uche Uwaleke, Professor of Capital Markets and Director, Institute of Capital Market Studies, Nasarawa State University, KEFI. Thank you so much for your insights on the rising inflation in Nigeria and implications for the retail investors. It is nice to know that retail investors have the opportunity to diversify their portfolio, to also deepen their knowledge and explore the opportunities in the mutual funds while they continue to monitor the developments around inflation and the high interest rate regime. That indeed shows that there's light at the end of the tunnel. Thank you very much once again, Prof, and hope to have you discuss further on developments as it affects the economy and the capital market, because the capital market plays an integral part in the economy. Thank you once again.
Thank you, Ekon. Thank you. God bless you. My pleasure.
Thank you. To our viewers, if you want to get further insights on this conversation, visit the ProShare website displayed on the screen and follow our social media platforms to engage further. Till we come your way again, Enrich yourself with the knowledge of socioeconomic developments around you because it is a wise thing to do. I'm Ottoabasi Abasiekong. Thank you for watching, and bye for now.